Well, you just finished your 2025 taxes and you're tired, you're frustrated, and you're probably thinking to yourself, I never want to pay this much again. Well, welcome to 2026 because the tax game has officially changed. And thanks to the One Big Beautiful Bill Act, the one size fits all standard deduction era is over. We're moving to a line by line strategy where your life choices, how you work, what you drive, and even how old you are can save you thousands in taxes. So this is a tax opportunity. Take advantage of it. Hi, my name's Sally Boyle, and I help folks who are within 3 years of retirement retire into a lifestyle they can't wait to wake up to. So it all starts with line number 11 of your tax return, your adjusted gross income. Why is that? Because if your AGI is too high, your 2026 tax benefits start disappearing. So let's review just a few of them. Let's talk about the new car play. Are you planning on a new car in 2026? Well, first, check the door jamb. If it's a U.S. assembled car, you can deduct up to $10,000 worth of interest on your tax return. But here's the catch. This starts phasing out once your adjusted gross income is $100,000 or $200,000 for joint filers. So buy American, but stay under that limit so that you can get this $10,000 tax discount. Second is the senior deduction. If you're turning 65 this year, congratulations. The IRS has a gift for you. It's a new $6,000 deduction per person available for those, but only if your modified adjusted gross income is under $75,000 for singles or $150,000 joint. And then the third example I can give you is the SALT deduction. While the SALT deduction is an itemized deduction, which technically is below the line, the cap on how much you can deduct is determined by your modified adjusted gross income. So for 2026, if your MAGI stays below the threshold, you get the full enhanced cap. But if your income goes above $505,000, single or joint, for every dollar above that $505,000, your SALT cap is reduced by 30 cents. Now, there is a difference between the modified adjusted gross income and your adjusted gross income, but that's a conversation for another day. The point is essentially the same. So I'm going to give you some above the line power moves. And why are they called above the line? Because they are above line 11, your adjusted gross income, and have a direct impact on reducing it. Now, we've already talked about the car interest deduction, but there's also a non-itemized or charitable deduction. So even if you take the standard deduction, you can deduct up to $1,000 individually or $2,000 for joint filers for cash donations that you give to charities. And this is a bonus deduction in addition to your standard deduction. But the real power moves for affecting your adjusted gross income is really aggressive retirement deferrals. So don't just set and forget your 401k or 403b contributions, your commitment to your deferred compensation plans, or any salary reduction option that's available to you. We know that the limit in 24 is $24,500 for 401k and 403b contributions. And if you're between 60 and 63, there is a massive new catch-up contribution of $11,250. Now, for deferred compensation plans, the amount that you can defer is significantly higher. So consult your own plan. But these are the most significant ways that you can reduce your adjusted gross income by affecting your gross income to start out with. Now, everybody knows this is my favorite account, the old triple tax advantaged health savings account, and that's a second consideration for you. If you have a high deductible plan, the HSA is the ultimate AGI shredder. $4,400 for individuals, and $8,750 for families. And there's a pro tip here that if you can do it through your payroll cafeteria plan, the HSA, not the FSA, the HSA, you can also dodge the 7.65 FICA tax as well. And then there's another aggressive move for those folks who have a side hustle. Even if it's a small side gig, it unlocks CEO level deductions for you. You can deduct 100% of your health insurance premiums on Schedule 1, no 7.5% floor. Plus, you can fund a solo 401k and shield up to $72,000 of your profits and salary deferrals. And this is massive. So the 2026 tax year isn't about how much you make. It's about how much you report on line 11. So start planning now before the tax year slips away. Now, I put the 2026 deduction limits in the description below. And if you would like for me to create a custom 2026 savings checklist based on your specific income bracket, just give me a comment. Or better yet, schedule a consult with me in the link below. Happy planning.